Hello again, this is Jeffrey Yong. Today I'm going to talk about the AI bubble and whether a crash is coming. First, we look at the stock market and how it is performing. So far, the S&P 500 earnings is up 10% in quarter three. Revenues growth is up 8% due to a rebound in international revenue. 40% of S&P 500 comes from abroad. So remember that when you invest in the S&P 500, you're not just buying the US economy, you're actually buying the global economy. And on the bottom right-hand side, that's the Carson's leading economic indicators, and developed markets ex-US is growing above trend, particularly Spain, Italy, Germany, and Netherlands. On the extreme right, emerging markets are also recovering in terms of the economy, and you can see that China, Taiwan, and Korea are particularly growing strongly. Now, whenever the LEI drops below 1.0, that's where we have a recession, and that usually coincides with a stock market crash or a bear market. So we are not seeing any of these danger signs as of now. So economy is actually recovering, and there's no recession in sight. Next, we look at what's driving the economic growth in the US, and is the S&P 500 in a huge bubble. Now, we need to look at several things. First, moral of story, don't fight the loose fiscal policy. In the US, one big beautiful bill, the OBBB, to increase deficits by US 4 trillion in the next decade. That deficit has ballooned to 6 to 8% of GDP, which is a historic high. And tax cuts are retroactive to 2025. Example, tips and seniors' incomes are no longer taxable, so households will see tax refunds in the first half of 2026. That we all know that whenever money is put into the pockets of retail investors and households, a lot of it flows into real estate and the stock market. So you could see a repeat of a continued bull run into 2026. Another point is the tariffs have also come down. The current level of tariffs is 11 percentage points higher than the start of the year. So it has not gone to that 50% increase like we all fear. It was used as a bargaining chip. So companies have kind of figured out how to deal with the tariffs. Earnings growth has remained very strong. So this is evidence that companies have overcome this uncertainty. Now, will the Fed continue to cut rates? There are two sides of the coin. One is that inflation is still elevated at 3%. However, the labor market is weakening. So the Fed is in the devil in the deep blue sea. It's likely to cut the rates to 3% next year. And over here is the Fed policy rate expectations. We are likely to see a rate cut to 3 next year and then gradually rising in 2026. Another thing is called the momentum. There are a lot of hedge funds that use momentum-driven strategy. So that means that 6 months after a major rally, turnaround rally, these automated hedge funds with algorithms will add on to the stock market to follow the momentum. And there's a lot of scientific evidence, empirical evidence over the years about it. Some define momentum as the last 12 months that the market has been up. Some define as 6 months, some is 3 months. So studies have shown that after a 6 months rally, the S&P 500 is likely to rally 3.4% in the next 3 months with 75% accuracy. 6 months later, up 4.8%, a positive of 73% of the time. And 12 months later is 9.7%. versus 9.3% for all periods, 79% of the time. So there is this momentum factor that is pushing the stock market up. Over here is the left-hand side is by fund strat, and it shows that so far in the last 3 years, rally has been 85% over the 3 years. And this time round, 80% of the fund managers have underperformed the market year to date. So there's a push to be long, to chase up with the laggard. And if the fund manager is behind the index, the S&P 500, they will be pushing their returns and deploying money to catch up with the year-end rally. So we could see a 5 percentage point increase in the final fourth quarter to end the year at 21%. On the right-hand side is again from Carson Research. It shows that the last 2 months of the year could be strong after a year-to-date 10% rally in the S&P 500. So seasonality effects play a part, and historical evidence does add to it. So on average, last 2 months of the year in the final column, median increase is 5.2% throughout history. On average, between 1950 to 2024, median is up 3.9%, 77.3% of the time higher. But this effect is now stronger from 1980 to 2024. It's 91% of the time higher with median of 5.2%. So we could still see S&P ending up the year above 7,000 points. Now, is this a most hated rally? What constitutes a bubble? We have to remember that back in year 2000, almost everybody is bullish about stock market. The hairdresser, the taxi driver is discussing about what stock to invest in. I remember I started work around that period, and I'm given advice by these people. No disrespect, but it's just that they are not savvy in general. So in 2007 as well, most of the financial advisors were trading stocks, and almost everybody has become suddenly a stock star investor somewhat. Now, one sign that it is not a bubble is where it becomes a hated rally. That means the sentiment is poor. Remember, bull run always climbs a wall of worry. Okay? There is a lot of worries about this, the war, the tariffs, and that causes the stock market to go up. Now, in this case, S&P 500, in fact, the latest has shown that earnings are up 13%. It's incredible, right? Earnings per share is growing at 13%, but yet consumer sentiment from the University of Michigan is at an all-time low. In fact, it is lower than the year 2000, is lower than 2008, and lower than during COVID. So I would say that under such scenario, yet the stock market is going up. Okay, so everybody is tightening their belts due to uncertainty, and yet it is bullish. The stock market is still up. It's climbing a wall of worry, so not a sign of a bubble. Next, this is another evidence of hated rally. Over here, in 3 years in the history, saw the bears outnumber the bulls by more than 10%. It is in 1990, 2008, and 2022. All 3 times when the number of bears outnumber the bulls by 10% or more, it is a bear market. But in this instance, this year, the bears have again outnumbered the bull by 10.9%, yet the market is up. So you can see it should be down based on sentiments, and yet it's up. It is a hated rally. Right now, we will discuss about the AI bubble. Ever since the ChatGPT has been rolled out in 2022 December, right? S&P 500 has been up 71.6%, which is the white line. Nasdaq up 111.3%, which is the green line, and Dow Jones up 42.2%. Clearly, tech has really outperformed since OpenAI due to a lot of investments. So where have the investments gone to? Information processing equipment is up 16%, which is a 35% annualized pace. Software has lagged behind with 23% annualized pace. So a lot of investment has gone to all the hardware makers. So for the first time, AI has contributed 1.05 percentage points to GDP in the first half. That really beat the 1995 to 2000 tech bubble, which is up 68, which contributed 68 bips to with a quarter, and 2001 to 2024 is only 24 bips, okay, to the GDP growth. Now on the left-hand side, equipment information processing grew at 35% annualized, okay, versus the 22% for software. So a lot of money is to put into equipment, and that ranges from the first half of this year, 2025. But from 2010 to 2019, equipment has lagged behind software, which is 7% over here, annualized increase versus 9% software. So it depends. So you see that the SaaS or software related spending has actually gone up a lot the last 10 years, whereas the equipment makers are more prone to boom and bust, and it has led the way this year due to the AI spending. So AI related investments is now as large as during the dot-com era. If you see the left, this green line, it has reached the peak here. In fact, it surpassed residential boom. Okay. And equipment and software contributed 109 basis points to the GDP in 2025. Huge contributions. So I'm building up to a story that it could be a bubble or yet it could not be. So let's look at this from Bloomberg. First, NVIDIA invests in OpenAI. So then OpenAI buys from Oracle. NVIDIA buys cloud from CoreWeave. OpenAI buys from CoreWeave as well for the cloud storage. OpenAI then buys AMD chips. US invests in Intel. And then NVIDIA invests in Intel to co-develop chips. US takes a 15% cut of NVIDIA and AMD's chip sales to China. And a lot of people say, what is the government doing involved in all this? And government is not good at allocating resources. On the right-hand side is where what OpenAI is involved, and it all seems like a web because OpenAI is helping to invest in data centers, cloud. Cloud goes to Amazon, investment hosting, and then they've got investments from SoftBank. So everybody's worried, but do you remember this is quite similar to Temasek, Singapore's Temasek, right? Sovereign Wealth Fund, which has a finger in almost every pie in Singapore's government-linked companies. So GLC is nothing new. Okay, maybe they're learning from Singapore. So I would say that there is nothing to worry about in this case. I wouldn't be too concerned. Let's inspect the web again further. So in the first place, they are fundraising at a higher valuation in each round. So OpenAI partners chips companies like NVIDIA, Intel, AMD, collaborates with hyperscalers who provide large-scale cloud computing capacity like Microsoft, Oracle, Amazon, Google. Okay, so chip makers have new orders and AI workload visibility. Hyperscalers have more cloud demand from AI workloads. AI partners chip companies like NVIDIA, Intel, AMD, which collaborates with hyperscalers who provide large-scale cloud compute capacity like Microsoft, Oracle, Amazon, Google. So chip makers have new orders, and then AI workload visibility. So hyperscalers, more cloud demand from AI workloads. Okay, so stock price of chip makers and hyperscalers surge. So OpenAI valuation is up also because they can show the utilization that's going on. So OpenAI access funding with higher valuation, and then higher valuation and capital inflows, secure more chips, expand AI-related training, enter more partnerships with hyperscalers, and so on and so forth, and more partnerships, and it goes round. This is the flywheel. So AI capex keeps rising. So Meta recently secured $2 billion in financing from lenders to fund constructions of massive data center. That is off Meta's books. There's one way to do it is to set up SPV and own it below associate level, below 20%. And they have a joint venture with Blue Owl. And you may have to give some corporate guarantees. And this is all off financial. The balance sheet, if it's at associate, it doesn't roll up because it's not consolidated in your balance sheet. And big tech spending is expected to keep climbing. It's like Meta, Alphabet, Amazon, Microsoft, all of them are increasing their investment. And it's like a nuclear arms race. Now, let's talk about the flywheel effect. It starts at the top. Hyperscalers build the data centers. okay, with cash flow, they get a lot of investments. So hyperscalers, remember, are Microsoft, Meta, Alphabet, Amazon, for example. So funding cash flow, they form JV special purpose vehicles, okay. So these JVs, SPVs will set up REITs, infrastructure funds to build data centers, which in turn are customers of power assets and real estate owners. And then they collect data centers, collect cash flows up. Okay, they earn a fixed return. So private credit lenders lend to the data centers, which again pays to private credit lenders. Now, hyperscalers, private credit lenders, data centers, which part of the flywheel or the chain is the strongest? I would say that the REITs, the lowest stream players, REITs, infrastructure funds, private credit lenders, they receive stable cash flows and bond-like returns. Okay, their upside is, I would say, stable and limited, but the downside is quite large. In case this capex, AI capex slows down, a lot of these data centers, power providers, infrastructure, private credit especially, they will be hit. Okay, upside is limited, maybe 8 to 10% yield. Downside is a lot. Okay, some of the players may go bust. Now, on the upstream, hyperscalers, the upside is unlimited. They get equity side returns. That is why I tend to prefer to participate on a business with equity upside rather than bond-like returns. So downside is limited. So what they put in money are, like, for example, Meta, they have an associate level with Blue Owl, owns only 20% of it, and they created that to leverage up to build data centers cloud capacity. So the downside is limited. What they put in, that's it. It gets wiped out. But the hyperscalers have unlimited upside, because if the AI spending reaps revenue, monetize it, then their revenue will go up. And even if it doesn't work out, okay, they can still sell ads. Their cloud services, AWS, will still go on. So unlimited upside, downside is limited. So in conclusion, based on CEO interviews, the deal front and financing is going to continue for a while. It's unlike the Y2K, where everything has to be ready by the year 2000, because remember the time where the years, whenever you fill in things, they never include the year 2000. It's like 99. 1999, they put 99. So, we have to change all this back end, and then Y2K happens. And they are warning at that time that, okay, if there is they were saying that, okay, major disasters going to happen in Y2K. And after that, the spending stops. Now, so this AI arms race is going to last for a while. And large tech companies have low debt right now. A lot of these tech companies, SaaS, they are not driven by debt. So there's more room to leverage. And as long as the company has very low debt to equity, in fact, I would say 0.5 times debt to equity, it's fine. And it's arms race. You have to invest in AI to keep up. Okay, it's unlike Y2K, then that's it. After year 2000, there's no more spending, it's done. If you don't invest like Adobe, if you don't invest in AI, you really get left behind. So AI is in our everyday life. Y2K was more of the back-end spending, and spending will continue for a while. So higher spending will lead to higher profits. The thing is, large tech companies have low debt. And the other thing you look at, as long as the revenue keeps rising and the visibility is there, and the management continues to guide earnings up, revenues up, particularly top line, I will say that the spending will continue, the flywheel continues, and AI is in our everyday lives. So finally, this is a nuclear arms race that will not end at a certain date. There may be infrastructure overspending, but the hyperscalers are fine as long as they have low debt to equity below 0.5. And also go for the very diversified tech companies, diversified earnings, and even if monetization from AI disappoints, the revenue will grow. at 10 to 20 to 30% per year, it's fine. So will we end up like Terminator and Skynet? Well, that's food for thought.